I couldn't wait. We had 45 seconds, but I couldn't wait because it looks like everything I said would happen is happening. What up, though, y'all? It's your boy Lando Success. When you come in, if you are live right now, hell, let me turn that down. Make sure you press that like button, press the subscribe button, because I'm going to keep you up to date with crypto news, stock news, gig jobs, different ways to make money, and some motivation. What's up? I hope all is well. Oh my gosh, we got so much to talk about. Since I might be too excited, let me know if I screen record or share something y'all can't hear sound, y'all can't see it, because I'm on 1,000 right now. Ooh, so the feds, they basically did their decision, and it's exactly what we expect it to be. It is a $30 billion deal, and let's go to that real quick. So we got 10 minutes before they go live. Oh my gosh, we got so much going on, you guys. All right, so if we go to the Federal Reserve, their Twitter, they just put this out 19 minutes, saying the Federal Reserve Board, the Federal Board Open Market Committees, they basically have their projections right here. And let's see their chart. Summary. We're not going to go through all of this, but they get everything and I'm going to probably do a video, like a nerd type video, breaking everything down with all of this mean. But they're going to increase rates probably 3 different times. They telling you the rates where they're going to increase it, exactly what is going on here. So you can check that out on your downtime, but we got good stuff to talk about. Now, remember I told you guys that crypto was going to go on a run on the 15th or 16th. And people in the comments, Orlando, it's not going to go up on no run. It's not going to shut up. What'd I say? Nah, if it's bad. Let's see. Oh, in the last hour, up 3%. Last day. So if you look at it, because it went completely down with this news coming out. Mind you, this could change in 9 minutes once Powell start talking, right? So remember I told you guys on my live earlier, we're going to get to the green today. Let's see what our crypto is doing. You see everything dipped down earlier, and it looked like it was going to be a bloody day, mates. Looked like it was going to be a bloody day. This is what I was talking about yesterday, that glitch. Look at this. $197,000 a coin. Let's go. Let's speak it into existence, beautiful people. Let's speak into existence. So the coin dropped all the way close to 50 cents today. It was a great day to buy because we have so much fear going on. And you see, it is running up as we speak. Literally, as we speak, we have a good run going up. And it's funny, if you go to the comments, everybody is I'm in meeting. Everyone buy BTC now. Let's go Bitcoin. Bitcoin to the moon. Everybody ready? Oh, yeah, this is about to be fun, yo. This is about to be fun. Oh, man, where's, let me switch back over. What's up? So what we're doing, in 7 minutes, I'm going to mirror the meeting live. So I'm going to show you guys the meeting. What the meeting basically is about, them giving away so much money when it came down to stimulus. That made a problem, and the economy is doing things that shouldn't be doing. So what they're trying to do is straighten everything out and coming out with a way. Now, the rich white guy that's about to be talking, he can completely mess everything up. He can change the market. So this is a very important meeting, one of the most important meetings we had. So I'm going to do my commentary. I'm going to probably pause it and kick it with y'all, but that would give people all over the world that can't find a meeting, they'll be able to come in here. Hopefully, if it works good, I hope they don't crash. If not, we gonna do a live anyway and talk about money. So it really makes me no sense, no different. What's going on? Love my dog in the building. What's up? Hope all is well. Brandon is in the building. What's up? I was up 8 billion yesterday on the glitch. You just seen the glitch I just showed. Hey man, Crow, 197,000. Let's speak it to existence. Let's all get this money. Let's leave our job while we at it.
They took my job.
Mamar. Oh, where you from, brother? What's up? Thanks for the stream. The virus never got me. Oh man. So I'm assuming you're in a different country where you can't stream it. But that's what you got me for. We gonna get this party started. Oh my god, let's look at the stock market. Let's see what's going on in the market. Man, I'm so excited right now. It's running up, y'all. Let's see if we go to my stocks. The Fed see 3 interest rates hikes in 2022 as inflation fight begins. We'll click that in a little bit. We're not going to do. So the Dow is in the green today. So it did spike up and it's spiking down. So it's in the green. Look at that. NASDAQ is in the green. Tesla's down. Ooh, it's a good day to buy some Tesla right now. Especially if you would have bought low right there. Let's see what this market is doing. My 3 favorite is all in the green. Hope you guys set up a account for that. PayPal is doing good. Are any of you guys hip to REITs? Y'all know about REITs? I did a bunch of videos on them. Let's see. Coinbase is down. Yeti, Neo, GameStop, DraftKings, Hood definitely gonna be down. Rivian, I told y'all about UPS and FedEx stuff. Biotech, yeah, good stuff, man. Everything is looking beautiful, beautiful. Let's go. If we looked at it right here. Welcome everybody that's in here. Let's go ahead and get these likes up. Press the like button for me. I appreciate you. Beautiful people. We about to get this party started in 4 minutes. So, wonder if it can hit 50,000 a day. That'd be crazy. That would be a great prediction. Look like Ethereum. Can Ethereum go back over 4,000? What I tell you guys earlier on my live, I said, anytime you can get Ethereum under $4,000, that's a win. Always. Always, always, always. Look at that. What did I say? So look, I like to, some people don't like to brag and stuff, but me, I am not one of those people. I'll definitely admit when I'm wrong, and I would definitely say I told you so. It's funny, I got a kid. My shit go from Mr. Beast to Elmo. So if we go on my channel, yo, and what did I say? Where's my videos? I think I did. We about to go on a rally is coming. So I told you guys a rally is coming 3 days ago. I said on the 15th or 16th, things are about to get real. So let's see if I can go to the Federal Reserve website and make sure everything is running good. We're going to test it so you guys can tell me if y'all can hear everything correctly. Let's see. All right, that sounds crazy. I'm about to mirror this and let me know if y'all can hear it. Give me 1 second. All right. Were y'all able to hear that? Oh, stop doing that. Much love, Raynell. What's going on? We got Georgia in the building. Georgia versus Michigan coming up. we got Georgia and Michigan. It's gonna be a great game. I can't wait for it. Last chance to get on this discount, baby. Rojas in the building. Que paso, Rojas? Que paso, mi amigo? I told you so. In the words of LeVar Ball, I told you so. A little loud. Okay, a little loud. So, yeah, we're going to just turn it down a little bit when we get over to it. Okay, y'all was able to hear it. So yeah, just let me know in the comments if it's sounding too crazy, because we want it to be organized and straight. How y'all day going, man? My day is going great. I didn't have an agenda, wake up agenda. I got up. I went to go pick up some money. Got paid some good money today, so that was great. I went to the gym, but since I was rushing, because the guy told me I had to go pick up the money by noon before they went on break, so that threw me off, and I went to the gym to do arms, and I just rushed. I did like a quick 45-minute workout. I'm gonna go back and do cardio and finish it out. Okay, I said it was loud. We're gonna get this thing right, so it should be live. I'm not gonna transfer it over until, I don't know why they got it so loud. Like, it's crazy. Jeez. Okay, so it says 2:30 now, but they're not fully live on it yet. Man, guys, this is some good news. So the people that's just coming in, appreciate y'all from checking in. Press that like button for me. Let's get these likes all the way up. The goal for this video, since I'm just now starting going back live, our goal is to reach over 200 likes. I got one last week with over 100. We going big today. We need 200 likes today so YouTube can see the algorithm and be like, oh, Orlando, cool. He actually, people actually like it. And feel free to comment, because I do go back and check it out. But yeah, I'm liking this run up that I'm looking at right now. Let's look at some more stuff while we wait. Okay. Stop that. Stop it. Oh, I think they about to get started. Are you guys going to get started? Because their music going off. But while we still waiting, I can mirror it back over. So for the people that just came in, you can go to the Federal Reserve Twitter. Let's see. Did I go on this?
Good afternoon.
There you go. All right,
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept interest rates near zero and updated its assessment of the progress that the economy has made toward the criteria specified in the committee's forward guidance for interest rates. In addition, in light of the strengthening labor market and elevated inflation pressures, we decided to speed up the reductions in our asset purchases. As I will explain, economic developments and changes in the outlook warrant this evolution of monetary policy, which will continue to provide appropriate support for the economy. Economic activity is on track to expand at a robust pace this year, reflecting progress on vaccinations and the reopening of the economy. Aggregate demand remains very strong, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook. Notwithstanding the effects, particularly if additional waves of the virus occur. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate declining to 3.5% by the end of the year. Compared with the projections made in September, participants have revised their unemployment rate projections noticeably lower for this year and next. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. As a result, overall inflation is running well above our 2% longer run goal and will likely continue to do so well into next year. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, but thus far, wage growth has not been a major contributor to the elevated levels of inflation. We are attentive to the risks that persistent real wage growth in excess of productivity could put to upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline to levels closer to our 2% longer-run goal by the end of next year. The median inflation projection of FOMC participants falls from 5.3% this year to 2.6% next year. This trajectory is notably higher than projected in September. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials, like food, housing, and transportation. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market, and to prevent higher inflation from becoming entrenched. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee reaffirmed the 0 to 1/4% target range for the federal funds rate. We also updated our assessment of the progress the economy has made toward the criteria specified in our forward guidance for the federal funds rate. With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessments of maximum employment. All FOMC participants forecast that this remaining test will be met next year. The median projection for the appropriate level of the federal funds rate is 0.9% at the end of 2022, about a half percentage point higher than projected in September. Participants expect a gradual pace of policy firming, with the level of the federal funds rate generally near estimates of its longer-run level by the end of 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. At today's meeting, the committee also decided to double the pace of reductions in its asset purchases. Beginning in mid-January, we will reduce the monthly pace of our net asset purchases by $20 billion for Treasury securities and $10 billion for agency mortgage-backed securities. If the economy evolves broadly as expected, similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated in early November. We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support. In addition, a quicker conclusion of our asset purchases will better position policy to address the full range of plausible economic outcomes. We remain prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to foster accommodative financial conditions. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
Thank you, Mr. Chair. We'll go to Rachel from the Washington Post.
They got a whole.
Thank you very much, Michelle, and thank you, Chair Powell, for taking our questions. The latest FOMC materials say that the FOMC thinks it will be appropriate to keep rates near zero until labor market conditions reach levels consistent with maximum employment, and there are also 3 rate hikes penciled in the projections for next year. In order to set up those hikes, what will maximum employment have to look like? When will you know that that threshold has been met? And how will that be communicated? Thank you.
Great question.
So maximum employment, if you look at our statement of longer run goals and monetary policy strategy, maximum employment is something that we look at a broad range of indicators. And those would include, of course, things like the unemployment rate, the labor force participation rate, job openings, wages, flows in and out of the labor force and various parts of the labor force. We'd also tend to look broadly and inclusively at different demographic groups and not just at the headline and aggregate numbers. So that's a judgment for the committee to make. the committee will make a judgment that we've achieved labor market conditions consistent with maximum employment. When it makes that, it is admittedly a judgment call because it's a range of factors. Unlike inflation, where we have one number that sort of dominates, it's a broad range of things. So, as I mentioned in my opening remarks, in my view, we are making rapid progress toward maximum employment, and you see that in, of course, in some of the factors that I mentioned.
Great, thank you. Steve at CNBC.
Thank you, Mr. Chairman. My question is, if it's often said that monetary policy has long and variable lags, how does continuing to buy assets now, even though it's at a slower pace, address the current inflation problem? Won't the impact of today's changes not really have any impact for 6 months or a year down the road on the current inflation problem? And aren't you actually lengthening that time by continuing to buy assets such that it could be not until the long and variable lag after you end purchases sometime in March that you'll start to have any impact on the inflation problem?
So on the first part of your question, which is why not stop purchasing now, I would just say this. We've learned that in dealing with balance sheet issues, we've learned that it's best to take a careful, sort of methodical approach to make adjustments. Markets can be sensitive to it, and we thought that this was a doubling of the speed. We're basically 2 meetings away now from finishing the taper, and we thought that was the appropriate way to go. So we announced it, and that's what will happen. The question of long and variable lags is an interesting one. That's Milton Friedman's famous statement, and I do think that in this world where where the global financial markets are connected together, financial conditions can change very quickly, and my own sense is that they get into financial conditions affect the economy fairly rapidly, longer than the traditional thought of a year or 18 months, shorter than that rather. But in addition, when we communicate about what we're going to do, the markets move immediately to that. So financial conditions are changing to reflect the forecast that we made, and basically, which was, I think, fairly in line with what markets were expecting. But financial conditions don't wait to change until things actually happen. They change on the expectation of things happening. So I don't think it's a question of having to wait.
Can I just follow up in thinking about having to wait? Is it still the policy or the position of the committee that you will not raise rates until the taper is complete? Thank you.
Yes, the sense of that, of course, being that buying assets is adding accommodation and raising rates is removing accommodation. Since we're 2 meetings away from completing the taper, assuming things go as expected, I think if we wanted to lift off before then you would stop the taper potentially sooner. But it's not something I expect to happen. But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets.
Okay, let's go to Colby at the FT.
Thank you, Michelle. Chair Powell, I'm curious exactly how much distance you think there should be between the end of the taper and the first interest rate increase. Back in 2014, the guidance that was given was for the Fed funds rate to remain at the target level for a considerable time after the end of the asset purchase program. Is that an approach you support now, or does the current economic situation warrant something a bit different? Thank you.
So we haven't made any decision of that nature, and so no, I wouldn't say that's our position at all. We really haven't taken a position on that. I will say that we did talk today. We had our first discussion about the balance sheet, for example, and we went through the sequence of events regarding the runoff and that sort of thing with the balance sheet last time. And I think people thought that was an interesting discussion. They thought that it was informative, but people pointed out that this is a significantly different economic situation that we have at the current time, and that the differences that we see now would tend to influence how we think about the balance sheet. And the same thing would be true about raising rates. I I don't foresee that there would be that kind of very extended wait at this time. The economy is so much stronger. I was here at the Fed when we lifted off the last time, and the economy is so much stronger now. It's so much closer to full employment. Inflation is running well above target, and growth is well above potential. There wouldn't be the need for that kind of long delay. Having said that, we'll make this decision in coming meetings, and it's not a decision that the committee has really focused on yet.
Let's go to Nick at the Wall Street Journal.
Thank you. Nick Tamaros at the Wall Street Journal. Chair Powell, in March, you answered a question about maximum employment like this. You said 4% would be a nice unemployment rate to get to, but it'll take more than that to get to maximum employment. More recently, you have hinted at a possible distinction between the level of maximum employment that's achievable in the short run versus in the long run. Has your view of the level of maximum employment changed this year, and if so, how? And how close is the economy right now to your judgment of the short run level of maximum employment? Thank you.
Right. So the thing is, we're not going back to the same economy we had in February of 2020, and I think early on the sense was that's where we were headed. The post-pandemic labor market and the economy in general will be different, and the maximum level of employment that's consistent with price stability evolves over time within a business cycle and over a longer period, in part reflecting evolution of the factors that affect labor supply, including those related to the pandemic. So I would say, look, we're at 4.2% now, and the unemployment rate has been dropping very quickly. So we're already in the vicinity of 4%. The way in which the important metric that has been disappointing really has been labor force participation, of course, where we had widely thought, I had certainly thought that last fall, as unemployment insurance ran off, as vaccinations increased, as schools reopened, that we would see a significant surge, if you will, or at least a surge in labor force participation. So we've begun to see some improvement. We certainly welcome the 0.2 improvement that we got in the November report, but I do think that it feels likely now that the return to higher participation is going to take longer. And in fact, that's been the pattern in past cycles, that labor force participation has tended to recover in the wake of a strong recovery in unemployment, which is what we're getting right now. So it could well have been that this cycle was different because of the short nature of it and the very strong, the number of job openings, for example. You would have thought that would have pulled people back in, but really it's the pandemic, it's a range of factors, but the reality is we don't have a strong labor force participation recovery yet, and we may not have it for some time. At the same time, we have to make policy now, and inflation is well above target. So this is something we need to take into account.
If I could follow up, you've talked recently about risk management, and so does that mean that the committee might feel compelled to raise interest rates before you're convinced that you've achieved the employment test in your forward guidance?
So this is not at all a decision that the committee has made, but you're really asking a question about how our framework works. And yes, there's a provision, what used to be called the balanced approach provision, that says in effect that in situations in which the pursuit of the maximum employment goal and the price stability goal are not complementary, we have to take account of the distance from the goal and the speed at which we're approaching it. And so that is in effect an off-ramp which could, in concept, be taken, and it's in our framework. It's been in our framework a long time. I've talked about it on a number of occasions. It is a provision that would enable us to, in this case, because of high inflation, move before achieving maximum employment. Now, as I said, we're making rapid progress toward maximum employment in my thinking, in my opinion, and I don't at all know that we'll have to invoke that paragraph. But just as a factual matter, that is part of our framework and has been really for a very long time.
Thank you.
Thanks. We'll go to Howard at Reuters.
Thanks, as usual. So I guess I got to ask about the elephant in the room, which is the Omicron variant. This seems to already be pushing one of your colleagues,
They don't
the Bank of
really
England,
have
off.
too much faith in unemployment, to be honest, because everything they're really saying when it come back down to unemployment is they're not going to really be able to change that. So that's why he keep on avoiding it, because he know how bad unemployment is. You really can't do too much about it. Just organize and do whatever you can.
Its course, things have evolved very fast there. Hasn't quite hit the shores of the U.S. in full force yet, but people seem to expect it to. So I'm wondering, in your feelings about this, are you convinced that this is going to be perhaps a more infectious but less serious variant of the virus, or are you simply confident that the U.S. economy?
I think there's a lot of uncertainty, which is why we called it out in our statement, our post-meeting statement, as a risk. We follow the same experts, and we talk privately to the same experts that everyone else does, and read the same articles in the paper and the same research. And so you mentioned the early assessment is highly transmissible, perhaps not as severe, some continuing protection from existing vaccines and also existing immunity from having had the disease. That's a first draft. We're a long way from knowing what it will turn out to be. It may well come to the United States and replace Delta as the dominant variant fairly quickly. That could easily happen. I think there's another step there, though, which is what's going to be the effect on the economy, and that will depend, on how much it suppresses demand as opposed to suppressing supply. It is not clear how big the effects would be on either inflation or growth or hiring, on top of what's already going on, which is quite a strong, wave of Delta that's hitting large parts of the country across the northern United States and all the way to the eastern seaboard, and now coming down. We're having quite a wave of Delta. So coming in on top of that, again, it's very difficult to say what the economic effects would be. I do think wave upon wave, people are learning to live with this. More and more people are getting vaccinated. So people who get the new variant, it affects them much less than it tends to affect in the aggregate people who are not vaccinated. So the more people get vaccinated, the less the economic effect. It won't have an economic effect. Delta had an effect of slowing down hiring, and it actually it had an effect on global supply chains, and that hurt the process of the global supply chains getting worked out. So it can have an economic effect. I just think at this point we don't know much. We'll know a whole lot more in 3 weeks, and we'll know more than that in 6 weeks.
But if I could follow up, you're clearly from a risk standpoint comfortable putting away one of your tools
So it
pretty
look like
soon,
the market is
which sort of
leveling
implies that.
out just a little bit. Let's go back to it, because they say the same thing. We go back and forth. Let's see. Let's first see what the stock market. Let's see what is the Dow. Okay, the Dow went down and it's starting to go back up. So Dow doing good. Nasdaq doing good. And if we go up, turn this down. All right, so if we go back over, I like crypto, we go to Coinbase. Where we at over here? Okay, 24 hours. Doing good. Uh-oh. Bitcoin is getting back closer. So I think we got another spike might come. So we might get it back over to 49. I'll let y'all know when we get back over to 49. Back over to you, Al.
To support, certainly we had 5 months of declining month-on-month monthly readings of inflation, but we didn't see much in the way of progress on labor supply or on other supply side issues. Then in September, I'd say after Labor Day, we started to see, it started to become clear that this was both larger in its effect on inflation and more persistent. And of course, I said so on many occasions. And one of the consequences of that is that we moved the taper forward. We moved the taper forward, and it's a much faster taper than had been planned. So we've been adapting. I've been saying we're adapting our policy. So come to your real question. We got the ECI reading on the eve of the November meeting. It was the Friday before the November meeting, and it was very high, 5.7% reading for the Employment Compensation Index for the third quarter, not annualized, for the third quarter, just before the meeting. And I thought for a second there whether we should increase our taper. Decided to go ahead with what we had socialized. Then right after that, we got the next Friday after the meeting, 2 days after the meeting, we got a very strong employment report, and revisions to prior readings, and no increase in labor supply. And the Friday after that, we got the CPI, which was a very high reading. And I honestly, at that point, really decided that I thought we needed to look at speeding up the taper, and we went to work on that. So that's really what happened. It was essentially higher inflation and faster, turns out much faster progress in the labor market. Really what's happening is the unemployment rate is seems to be catching up with a lot of the other readings of a tight labor market, 0.6 over one cycle. So that's really what happened. And, widely supported in the committee today. As you can see, unanimous vote. But beyond that, I think widely supported this move.
If I could just follow up quickly, you noted that the ECI was one of the things that made you nervous, but you also said earlier that you don't see signs that wages are actually factoring into inflation yet. And I guess I wonder how you think about sort of the wage picture as you're making these assessments.
Right. So what I said, you quoted me correctly. It's so far we don't see wages are not a big part of the high inflation story that we're seeing. As you look forward, let's assume that the goods economy does sort itself out, and supply chains get working again, and maybe there's a rebalancing back to services and all that kinds of thing. But what that leaves behind is the other things that can lead to persistent inflation. In particular, we don't see this yet, but if you had something where real wages were persistently above productivity growth, that puts upward pressure on firms, and they raise prices. It would take something that was persistent and material for that to happen, and we don't see that yet. But with the kind of hot labor market readings, wages we're seeing, it's something that we're watching. And the other thing, of course, is rents, which are very important. Owner's equivalent rent and rent. That's another thing which is very economically sensitive. Unlike the things that are causing the inflation now, this is economically sensitive, and so would be expected to move up. And so as some things go down, the question is, where will we be when we come out the other side of this? And we need to keep our eyes on those things.
Thank you.
Thanks. We'll go to Chris at the AP.
Thank you. Well, next year you could see growth slowing, and you could see some disinflation, particularly if the Omicron variant does spread more widely. Would you delay rate hikes in that situation, and how would you think about that? And also, how would you explain rate hikes if you do follow through in that kind of situation with inflation fading and growth slowing? How would you explain rate hikes to the public, particularly those who may still be looking for work?
Well, as you know, the SEP is not a plan. It's not something we debate, negotiate over, or really discuss in terms of what the right answer should be. People write down their assumptions, their assessment of appropriate policy based on their economic forecast. And so the median, what you're talking about, the 3 rate increases, that's the median of the committee. The median of the committee is also that growth will be 4%, and that unemployment will be 3.5% by the end of the year. So that's a really strong economy. And of course, if the economy turns out to be quite different from that, then so will the rate. No one will say, oh, we can't change our policy because we wrote something down in December. That no one's ever said that or will. It will. The actual rate decisions we make will depend on our evolving assessment of the forecast. So, for example, if the economy were to slow down significantly, then you would expect that would have an effect of slowing down rate increases. But we'd have to, we look at our 2 goals, maximum employment and price stability, and we make policy based on them, and not with respect to what we wrote down in a prior SEP.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to follow up on maximum employment. So, the new framework was basically designed, as I understand it, so that there was a de-emphasis on guessing where inflation would pick up because of employment. And basically, you were going to wait until you saw the whites of the eyes of inflation, and that's how you would kind of know that you reached maximum employment. So I'm wondering, you've talked a lot about the different ways that you might measure maximum employment, but from what I understand, and that's still basically the way that you know that you're there, is inflation. So is that understanding correct? And how are those signals likely to be clear right now, given that you have inflation that's caused by these supply chain disruptions that might also lead to inflation in wages and those sorts of things? So how do you sort of like tease out the signal of maximum employment? Okay.
So let me start by saying that the inflation that we got was not at all the inflation we were looking for or talking about in the framework. It really was a completely different thing. It was to do with, strong monetary policy and fiscal stimulus into an economy that was recovering rapidly and in which there were these supply side barriers, which effectively led to, in certain parts of the economy, of what you might call a vertical supply curve. So, automobile purchases are very interest rate sensitive, and you would think demand would drive up the quantity of cars, but it can't because they don't have semiconductors. So, that was a very different.
Boring old white man talking, and put me on the screen. What's going on, everybody that just came in? Press the like button, press the subscribe button. So we got the big old meeting going on today. We all talking rates, prices going up. Let's see where we at right now before I go back to them talking about rates and inflation and all that type of good handy dandy stuff. Bitcoin. Okay, it's still right around the same, so it's still looking good. Let's see, what is some of the biggest movers going on crypto? Top gainers. Let's see who got the biggest change. We see 4%. Ethereum I'm telling y'all, Ethereum about to go back over $4,000. Solana's up 14% right now. Avalanche, I showed you guys this earlier, is up 24%. Polygon is back over $2. What we say earlier. Oh man. Yeah, let's get back to the meeting. Jeez. Good stuff.
Yep. So how do we think about that? If we think we can make labor, participation might move up. If let's say we knew that it would start to move up in 2 years, would we wait 2 years or when inflation is running way above target? Probably not. So you have to make an assessment that what is the level of maximum employment that is consistent with price stability in real time is one way to think about it.
Just to kind of follow up on that for a second, if you do raise interest rates next year and you're not certain whether you're at maximum employment, I mean, are you all going to point, when you raise interest rates, are you going to point to ways in which the labor market could still improve?
Yes, I mean, I absolutely. I think whether or not we say we're at labor market conditions consistent with maximum employment next year, we would all be open and I think expect over time that the level of maximum employment that's consistent with price stability would increase further over time. For example, through increasing participation. So we would certainly we would not in any way want to foreclose the idea that the labor market can get even better. But again, with inflation as high as it is, we have to make policy in real time. We've got to make that assessment in real time.
Thank you. We'll go to Olivia from Bloomberg.
Thank you. Good afternoon, Chair Powell, and thank you for taking our questions. I wanted to follow up on some of your earlier comments about labor force participation. And I wondered, what do you think needs to change in the economy to kind of get a meaningful recovery in labor force participation? And also whether running the economy hot, like in the last expansion, is one way of doing that.
Well, the labor market is, by so many measures, hotter than it ever ran in the last expansion. If you think about it, the ratio of job openings, for example, to vacancies is at all-time highs. Quits, the wages, all those things are even hotter. But what would it take for labor force participation to move up more? That really, why is it low is the question. So there are a bunch of answers, and all of them probably have some, some validity. Part of it will be that people, for certain people, they don't want to go back in the labor force because either they're medically vulnerable or they're not comfortable going back while COVID is still everywhere. That's one thing. The lack of availability of childcare for caretakers is certainly part of it, not just for children, but for older people. It has been pointed out by many that the stock market is high, people's portfolios are stronger. They may go back to being a one-income rather than a two-income family. The same thing with people's houses. People they have a mortgage, and with leverage, and the house price increases, the equity they have in their home might have doubled, and they might reach the same conclusion. So and people have savings on their balance sheet because of forced savings, because they couldn't spend on travel and things like that, and also because of government transfers. So for all of those reasons, and it's hard to know exactly the part each of them plays, we have a situation where we've had a shock to labor force participation that is not unwinding as quickly as many has expected, and people, in effect, a good part of it is voluntary. People, and this is how they want to maximize their welfare, and that's certainly their choice. In other cases, it's something that will abate very quickly if and when the pandemic gets under control. And the longer the pandemic goes on, maybe the less likely that people will come back because they get used to their new life and they lose contact with their old jobs. That's what the evidence would say. So it's a range of things. It isn't that the economy lacks stimulus. Usually in every other expansion, it's that there aren't enough jobs and people can't find jobs, and we're stimulating demand and trying to get demand to come up. That's not the problem here. The problem is a supply side problem, which what it would take to work it out, I think it's going to be time. And the number one thing it would really be to have the pandemic.
Yeah. Hold on. Intermission, we just hit over 49,000 with Bitcoin. Let me show you. Bam. Come on. What I tell you. Okay. 49,000. Can we get 50,000? 50,000. I think it's going to go back down to 48. But this is interesting. So we just hit 49. We need Crow to stay over 53. I want Crow to hit 60. It's not going to be easy. Now, Polygon is going nuts. So it's in its own lane right now. Come on. All right. So, okay. Your high was at 56. Okay, go ahead up to 56. So the market is reacting great to this, and that's what I predicted. Yep, and look at the Dow is going up. NASDAQ is going up. Tesla didn't flip. Tesla is green. Oh, boy. Things is getting real, y'all. It's getting real.
A tight but stable labor market where people are coming in, they're getting in the labor force, they're getting paid well. In the labor market we had before, we had the biggest wage increases were going to people at the bottom end of the wage spectrum for the last couple of years. There were just a lot of really desirable aspects of a labor market like that. Higher participation is one of them, and we'd love to get back there. But again, ultimately, we have the tools that we have, which are essentially to stimulate demand and also to control inflation. I mean, really, it might be one of the two big threats to getting back to maximum employment is actually high inflation. Because to get back to where we were, the evidence grows that it's going to take some time. And what we need is another long expansion like the ones we've been having over the last 40 years. We've had, I think, 3 of the 4 longest in our recorded history, including the last one, which was the longest in our recorded history. That's what it would really take to get back to the kind of labor market we'd like to see. And to have that happen, we need to make sure that we maintain price stability.
Okay, let's go to Edward Lawrence at Fox.
Thanks. Thanks, Michelle, and thanks for taking the question, Chair Powell. So I was looking at the census data there for estimate monthly changes on sales, and what you're seeing is fewer people spending at restaurants and drinking places, more people spending at grocery stores. You see electronic sales down 4.6% month over month. Also, department store sales down 5.4% month over month. How concerned, or what is your level of concern the consumer may be turning away from this economy or pulling back because of inflation, the virus, or something else? Thank you.
We see consumer expenses very strong in this quarter. I don't know, Edward, whether you're talking about more shopping online versus shopping in the store, but consumer demand is very strong. Incomes are very strong. Because people are going back to work and they're getting wage increases. Admittedly, some of the wage increases are being eaten away by inflation, but nonetheless, incomes overall are going up really significantly because of increased employment, and spending has been strong. There may be something in the seasonality that this year's holiday spending may have been pulled forward, and of course there may be effects from Delta, and there might be going forward from Omicron. But fundamentally, though, the consumer is really healthy, and we expect personal consumption expenditures to be pretty strong in the fourth quarter.
Okay, let's go to Mike at Bloomberg.
Mr. Chairman, the median forecast for inflation in this month's or this meeting's economic projections has been revised up significantly for 2021, but barely moved for 2022 and 2023. You've said you expect inflation to fall significantly. Is that because you're going to raise interest rates, or because the virus is going to fade and the effects are going to fade? In other words, is it a question of when, not if, you raise interest rates? And does it suggest that maybe your critics are correct and you might be afraid you're behind the curve?
So actually, I'm looking at the SEP here, and the median forecasts for core and headline inflation did move up by 0.4 each. So that's a significant, in an SEP, that's a pretty significant move up. It's based on both of those things, I suppose. I do think there's a broad expectation among forecasters, including our own, that the bottlenecks will alleviate sometime over the course of this year. If you look at where blue chip forecasts are, which is the group of well-resourced large forecasting operations with a long track record, they'll show inflation coming back down significantly toward the back end of next year. I would say, though, as well, that our policy should begin to have an effect. There will be a lag, but it should begin to have an effect on that as well. That's the most likely case. I guess what the thing I would want to say, though, is...
all right, we can pause on this part because this part is just BS. It's like, don't give us SHIT and tell us it's like glitter or something. Yeah, whatever on that part, because I'm not talking nothing. Let's go back to this beautiful market and what it is looking like. What's up to all the new people that just came in? We are talking about the Federal Reserve. I am Merriman, showing you guys what is going on with the meeting. Especially, I got a lot of international people that can't view it. So I got your back. Told you it's going to go right back under 40, go back to 48, but that is okay. That is cool. Went back to 48. Up, I guess over here. Here we go. There we go. So yeah, it's going to go back to 48, and I want to see what it's going to do. It's just been running up. That line is not good enough though, so we would need it right here. So what would that be? I don't know. It's gonna be interesting to see how that go. Everybody that's in here, I hope all is well. I didn't want to hear all that lying part. Sorry for people that want to watch that. We didn't need to hear it. They just lying right now anyway. So yeah, the market is looking good so far. My Ford stock is in the red. My airlines, all airlines is down. Let's see what they're saying on the main screen. Good old main screen. Let's see. The Fed's officially, okay, they haven't updated this yet. All right, let's go see if they're not lying to us right now. See if they got it together.
I would say asset valuations, I'm going to go really superficially here, but asset valuations are somewhat elevated, I would say. Debt owed by businesses, and households. Households are in very strong financial shape. Businesses actually have a lot of debt, but their default rates are very, very low. But nonetheless, it's something we're watching. Funding risk is, by and large, low among financial institutions, but we do see money market funds as a vulnerability, and would applaud the SEC's action this week. Leverage among financial institutions is low in the sense that capital is high. So overall, financial stability. That's how I would make an overall characteristic, but we break it down into those pieces. In terms of the things that we're looking at. It's the things we've already talked about to some extent. It's the emergence of a new variant that could lead to significant economic. If there were to be a variant, for example, that were quite resistant to vaccines, it could have another significant effect on the economy. We don't see that. We don't have any basis for thinking that the new variant that we have is that one, but it's certainly one we're looking at. I would say, cyber risk, the risk of a successful cyber attack is, for me, always the most, one that we would be very difficult to deal with. I think we know how to deal with bad loans and things like that. I think more a cyber attack that were to take down a major financial institution or financial market utility would be a really significant financial stability risk that we haven't actually faced yet. So I could go on with a list of horribles, but I think that's a decent picture of where I would start.
How about the cryptocurrency issues? Anything that worries you there that's going on in there in terms of, it's obviously a lot's happening in that sector. Is that concern you at all?
I think the concerns there are not so much current financial stability concerns. I, of course, would support the views expressed in the President's Working Group report on stablecoins.
So, okay, let me come back. He just said what is more important. The most important is a cyber attack, not a terrorist attack, not the market crashing. And it is all about cyber, because like how we just had that glitch yesterday. You get into these big companies' data, that is what they're worried about. So he just gave some real good game right there when you're talking about a cyber attack. That's a lot more important and heavy if you really think about it. Come on, buddy.
To provide a safe and reliable, trusted currency. So, but I do think those are longer term. In terms of, the more the cryptocurrencies, that are really speculative assets, I don't see them as a financial stability concern at the moment. I do think they are risky. They're not backed by anything, and I think there's big consumer issues for consumers who may or may not understand what they're getting, and there's certainly developments in the markets that are worth following, which are really not in our jurisdiction, but things like the kind of leverage that's built into them and those sorts of things is certainly worth watching.
Let's go to Nancy Marshall-Genzer at Marketplace.
Very neutral on crypto, y'all. He kept it very, very neutral on cryptocurrency. He didn't down it. I don't know how that's going to affect the price, though. He didn't fully down it. All right, I'm going to check on my phone. I'm going to let you guys keep on watching, and I check on the back end. Interesting. He talked about crypto. He didn't down it, though. That's the good thing.
That can come. I do. And I think if you look at how we got here, I do think we've been adapting to the incoming data really all the way along, and noticing and calling out that if both the effects and the persistence of inflation, of bottlenecks and labor shortages and things like that. So we've been calling out the fact that were becoming longer and more persistent and larger. And now we're in a position where we're ending our taper within the next, by March, in 2 meetings, and we'll be in a position to raise interest rates as and when we think it's appropriate, and we will, to the extent that's appropriate. At the same time, we're going to be seeing a few more months of data. I don't actually think we're out of position now. I think this was an important move for us to make. I think that the data that we got toward the end of the fall was a really strong signal that inflation is more persistent and higher, and that the risk of it remaining higher for longer has grown. And I think we're reacting to that now, and we'll continue to adapt our policy. So I wouldn't look at it that we're behind the curve. I would look at it that we're actually in position now to take the steps that we'll need to take, in a thoughtful manner to address all of the issues, including that of too high inflation.
Let's go to Evan at Market News.
Hi, Chair Powell. Thank you. I was wondering if we should still be seeing the taper and interest rate hikes as separate. And secondly, in the last cycle, the Fed started shrinking the balance sheet when short-term interest rates were about 1 to 1.25% range. Do you think the FOMC might be able to potentially start running off assets before that this time?
Are they separate? So our interest rate, they are separate tools. So the asset purchases are a separate tool from interest rates. Stopping asset purchases does not remove accommodation. It just stops adding further accommodation, whereas raising interest rates starts to remove accommodation from what is a highly accommodative stance. The extent to which they'll be separated in time is something we haven't really discussed at the committee yet. We will be discussing that, obviously, in coming meetings. I don't think the last cycle there was quite a long separation before interest rates. I don't think that's at all likely in this cycle. We're in a very, very different place with high inflation, strong growth, a really strong economy. That as I mentioned, the SEP medians are for 4% growth next year, 3.5% unemployment at the end of the year, and the headline inflation of 2.6% next year, core at 2.7. So this is a strong economy, one in which it's appropriate for interest rate hikes. So they're separate, I would say. Your second question was?
My second question was about runoff.
Runoff,
in the last cycle.
So with the balance sheet, we did have a balance sheet discussion. It's our sort of a first discussion of balance sheet issues at our meeting this week. We'll have another at the next meeting and another at the meeting after that. I suspect these are interesting issues to discuss. Didn't make any decisions today. We looked back at what happened in the last cycle, and people thought that was interesting and informative. And
Crypto.com numbers is a lot different. That's the funny thing about most of these different platforms. What's up to everybody that's new in here? I am Lando Sess. Ethereum just hit over 4K. Let's see. Crypto, CRY, crypto.com. Yeah, so each platform usually have something different. So for those new that's in here, we are watching the Fed Reserve meeting. Come on, dude. Why you got... I hate this new commercial that they get right here. You can't see prices. It's not letting me see rypto.com prices. Since it got the Matt Damon freaking commercial right here, you can't click past. Okay. All right, here we go. I just pulled up something different. I just pulled it up from right here. Crypto.com have Bitcoin over 49,000. And look at that in the last hour. So they got at 49.3, yo. Now, but they have crypto .com prices a little bit lower. I think they got them at 55 cents. Where are you? Yep, they got them at 55 cents. So each exchange usually have it a little bit different, but they got Bitcoin going right. So it's about to hit 56 cents. Look at Ethereum. Ethereum hit back over 4K. So we gonna monitor all of them, but they ain't talking about too much right now. We ain't missing nothing. Oh hell, I didn't click the wrong thing. Take me back. Oh well, I'll be able to pull it back up. So yeah, what's going on? How y'all enjoying yourselves as I go back to pull it up? There we go. There we go. Found it. I'll check all the comments with my phone.
The opposite, or it has been the opposite, where we have very high inflation, and we've had it since the labor market was in terrible shape. It had nothing. So far, this inflation has really nothing to do with tightness in the labor market. It does have to do with strong demand, and strong demand was supported by the Fed. It was supported by Congress. I'm not making any judgments on Congress. It's not my job, but I will just say we're coming out of what we certainly hope will be a once in a lifetime, certainly historic, the first really global modern pandemic, which looked at the beginning like it might cause a global depression. And, so we threw a lot of support at it. And what's coming out now is really strong growth, really strong demand, high incomes and all that kind of thing. People will judge in 25 years whether we overdid it or not. But, the reality is we are where we are. And, we think our policy is the right one for the situation that we're in.
Thank you. Let's go to Brian Chung.
Hi, Chairman Powell. Wanted to ask about the bond markets. When you see the 10-year at 146 basis points, do you have any sort of concerns about an environment by which you might be hiking interest rates into? Would you prefer the curve be a little bit steeper? What are you gleaning from the bond market actions over the last 6 weeks?
So I think the short end actions are easy to understand, which is, they're basically very policy sensitive rates at the short end, and it makes sense that's reacting to changes in expectations for policy. I think a lot of things go into the long rates, and the place I would start is just look at global sovereign yields around the world. Look at JGBs, look at bunds, and they're so much lower. You can get a much higher yield on U.S. Treasuries by buying USTs rather than bunds, and you can hedge the currency risk back into yen, back into euros, and still be way ahead. So in a way, it's not surprising that there's a lot of demand for U.S. sovereigns in a world, in a risk-free world where they're yielding so much more than bunds or than JGBs. So that's a big part of it. I also think. There may be some assessment in there of what the neutral rate is or what the terminal rate is. I don't know about that, but I would just say that we write down our own estimates of the terminal rate or the neutral rate of interest. Those are highly uncertain, and we'll make policy based on what we're seeing in the economy rather than based on what a model might say the neutral rate is. We all have the experience of the last cycle, where we all through that cycle were trying to estimate what the neutral rate was, and it turned out, I think we learned a lot from seeing what happens. We wound up cutting rates 3 times after raising them to 2.25% to 2.5%. So I'm not troubled by where the long bond is. I see that it's low. We're really focused on broader financial conditions. We're focused on maximum employment and price stability.
Let's have some quick fun. Hold on, let me turn this down over here. Let's go over to Twitter. What is the people saying in the Twitter world? This could go real good, it could go real bad, yo. Let's see. All right, I'll just show you guys live. Why not? Let's see. What is going on in the Twitter world? We put in the Federal Reserve. Oh, there we go. Last 50 tweets. Let's see live what people are saying the latest. Has nothing to do with your technicals. This Federal Reserve announced and see fears across the market. Look at every hit of dollar. You say Jerome Powell, the Federal Reserve, thinks what he's talking about. We are what's wrong with everything. Just took a massive asset bubble and made them explode even bigger for another 70-day minimum. The inevitable unwinding crash. Criminal negligence. Is this live right here? Oh no, that's just actually a part of it. So Twitter, people is not. Let's see. The Fed unexpectedly raised interest rates. What does that mean? I'm listening to the federal meeting. Let's see if they did any new tweets yet. Here we go. Answer reporters question video. Okay, so they got some stuff in here. The opening. All right. Look like price is still the same. It didn't do too much. Now we up 5%. Now it's back over 49,000 over here. And grows at 56 over here. So wonder, okay, so let's see if it went even higher. I don't know where the hell I did with the crypto.com one. I'll find out later. Back to you, James. And we done. Yep, we are officially done. Oh, I thought I had the screen switch back over. I just had it on me. Perfect timing anyway. Oh, let me exit out of this so you won't hear ever so gently music. What's going on, everybody? What are your thoughts about that? I want to know in the comments, what are your thoughts? I was trying to take notes, but with me mirroring the volume over there, I couldn't hear it too much because it was too loud when I first did it, and I had to listen to it a little bit on my phone. All my new people just came in. Welcome. What's going on? I hope all is well. Hope y'all are having a beautiful day. My day been great. I've been paid. I'm not mad at anything. It is a great freaking day. I hope all is well. And I would give let me go to the comments. Let me see what y'all been saying, yo. Let's go over. Martin, what's up? What's up? Priscilla in the building. How you doing, love? How are you doing? Hope all is well. Marcia is over. Crypto is rocking. So, it looks like I was right. I said a rally was coming. I said the rally was coming on. And I said this probably a month ago, a few weeks ago, then 3 days ago. I said a rally is coming on December 15th or December 16th. And especially for my Crow people, I said it's going to rally up and it's going to crash again between the 23rd through the 26th, because it can do it on Christmas, day before Christmas, day after. We don't necessarily know. I've never seen these sound effects. Can you guys hear this? Let's see. Can y'all hear those sound effects? I don't hear it in my headphones. So, yeah, we are doing freaking amazing. Done with his favorite word was strong economy and inflation. Inflation, strong economy, and yes. So, it I think overall it went good. It went good for the market because they came out with the decision earlier, and the decision was what everybody predicted to be a $30 billion plan, raise interest rates and do it over like a 3 different time span. And they put out a a blueprint of it. I'm going to show you guys that just came in here so you can learn. You can find it yourself. It's a bunch of nerd information, so you probably ain't going to be able to understand half of it. And when it went live, they got straight to the point. It was direct. It was smooth ran. We was able to mirror it good. He talked about the market. It's like what we expected. The job market. So with the job market right now, most people don't want to go back to work. Once we went through this pandemic, it changed the dynamic of the job force, because first, a lot of jobs let's say you had 100 people in the office every day. You just come into the office, 100 people. Once they went home and sent all of these people home, they realized 70% of them they really didn't need in the office. So it's like, all right, we don't need you in the office. Go stay home. The people that was laid off and started getting that big unemployment money, I necessarily don't want to come back. Then people started their own businesses. They started their different hustles. It's not fully worth it. So then you're telling me to come back, and it's like, oh, I'm making more money doing this at home. And with the economy booming, it's like, yo, I took this much money and the market is progressing. So, I don't necessarily need it. Oh, that's interesting. Let's see. We survived Daddy Powell. Yeah, we survived Daddy Powell. And the market didn't drop, man. Let's go see what's going on. I'm trying to get my sound. I don't want my sound to go too far down, and I don't want it to go. It's like a tough balance to get your sound right. All right, let's see what the market is doing. Welcome, everybody that's here. Press the like button. Let's get these likes on up. We got Anna. Say, what is peasant surprise when I open YouTube? Bienvenidos, Anna. Hope all is well. We've been partying. We've been laughing at Papa Powell. Printing money and all that good stuff. All right. We'll first look at Coinbase. Right now on Coinbase, in the last 24 hours, the market is up 5%. Me love. Oh, Bitcoin is over 49,000. They liked what they heard. So in the last hour, you see it's up 2%. Last day, and it's funny because it's so funny. Everybody projected that it was going to crash, and I'm like, it's going to rally. Because the reason I said that, crypto do exactly the opposite of which makes sense. It made sense for it to crash today. So it's like, no, we're going to do the exact opposite. So that is a great run. So now we're looking at it to get to 500 right here. Let's keep on keeping on. Price charts. What else we got? See who are our top gainers. Top gainers today. Spell token. I don't know what the heck is spell token. I guess it look brand new because it don't even got a market cap. We talked about Avalanche earlier. Now, Gods Unchained. I was going to do a video about Gods Unchained. I'll probably do a video about them. Is anybody invested in Gods Unchained? It looks like it just came out. Let's see. Just came out, last month? And I'm assuming it's a game platform where you probably need God tokens. It's just a great name, Gods Unchained. Let's see. Gods is an Ethereum token that power Gods Unchained, a blockchain trading card game. Gods can be used to craft NFTs. So, interesting. I would definitely probably do a video about them. Gods Unchained. Okay, I've seen this before. Yeah, and play for free. So that'd be fun to be able to play. I might like it. Yeah. Would y'all be interested in seeing a video breakdown of how this work? Because this looks kind of dope. I like it. Got nothing to do a little video. Let's see what else we got. Polygon is fooling, y'all. Polygon is fooling. Told you to buy under $2. Just keep on buying Polygon whenever you can. Just keep on buying it. And let's see. I think the all-time high went up to 246, bro. It's about to mess around and go back to its high. I love everything about Polygon. I'm going to always say positive things about them. Probably going to team up with them on something. I did a video about it if you guys want to know what's going on. Where is our handy dandy crow? We gonna see what is manic. 57. Yeah. Okay. Oh, that was too loud. I'm sorry. I apologize. I got too excited. Yeah, dog. We needed to get over 60 cents today, and it is going up 57. Yep. So we need to get over 60 cents. And my prediction will be looking perfectly. All right. Where is... We first do Decentraland. Decentraland, you up 6%. 3, so... And where is Sand at? SAND. Where you at? Where you at? Where you at? Bam. Sandbox. Sandbox just went back over $5. Look at this. Look at that big old drop. You could have got in at that 450 mark, 440. And now we back, baby. We back. Why is it doing this? That's weird. I think there's a big glitch still going on. The glitch haven't really been fixed all the way. Let's see what y'all talking about. What's going on, y'all? How you doing? All right, let's see. Lando, holla at me. What's up? What's up? What's up? Let's see. We got Dragonfly in the building. The Matic boys. Yeah, Matic is just such a freaking great buy. It's definitely the new Ethereum. Faster, easier. Everything is going a lot smoother. So I want to see what is these outlets saying about what they just seen. So let's see. If I did YouTube, if I went to, who would do a good overview? Would it be YouTube Finance? Let's see, Yahoo Finance. Yahoo Finance, if they do a reaction video. All right, I'm about to mirror it. Let's see if we can get a good reaction of what they're saying about it.
Surprises to the Fed, not only by the amount of fiscal stimulus, also by how quickly the vaccines worked to kind of bring back demand. And then, of course, that demand, particularly for durables, overpowering the supply. You know, we're seeing certainly substantial amounts of production, but not enough to keep up with the high demand, especially in markets where semiconductors are a big issue. So I think the Fed clearly made a mistake in their assessment of inflation, but they're trying to look forward and convince investors that there's still plenty of time for them to respond to that, particularly when our view, for example, is that you will begin to see moderation in inflation in the second half of next year. It'll remain above the Fed's target, and it's certainly appropriate for the Fed to be, increasing the speed of the taper, ending quantitative purchases, and certainly reasonable for them to raise rates. But we would expect to see fewer rate hikes than what the SEP is telling us.
Well, Mona, and speaking of the SEP, do you think the Fed is even going to need to raise interest rates 3 times next year, as the median dot had forecasted? Or is the mere signaling of tighter monetary policy going to be enough to set off market psychology in anticipation of that and potentially do the Fed's job for them here?
Yeah, that's a good point. You know, the communication of potentially 3 rate hikes next year, I think, does set market expectations. And we certainly saw, last week when Jerome Powell made that hawkish pivot to accelerate the taper, the markets very quickly priced that in, not only with the flattening of the yield curve, some of the more higher valuation parts of the market selling off.
The Fed's meeting. CNBC, they probably live right now. What y'all talking about, dog? I actually think we're well positioned. Oh, no, it ain't live. Oh, well, let's see who else we got in here as I look for some new things. What's going on, y'all? Hope all is well. We got Robbie and the building shorts getting wrecked. Yeah, if anybody did some shorts and went against the market today. They are taking a big major L. Look like the Dow is going to close definitely going to close good. The NASDAQ is going to close good. Majority of everything is in green, yo, to be honest. Majority of things are in green. It is a great day, man. It is a good day. Let's see. Stocks. Fed decision. Here's how. And it's funny. They don't want to update any information yet on what's their thoughts about it. Do y'all think Bitcoin gonna hit 50K today? Y'all think let's go back to, I want to see crypto RY. What I was saying, the reason I was able to click it this time. Good stuff. All right, let's see, show you guys what crypto.com is doing over here. Yep, let's get the like button. Let's get the likes up to 40. Get it over 40. Let's get it up. We are getting closer. And the last 1 hour, the highest it hit over here, right under 500, 49,455. And now it's going down for a little bit. I'll see last 24 hours of 3%. Just think of this. If you own a bunch of Bitcoin, just imagine making three grand in the last 24 hours just off of one coin. It's crazy. Ethereum still over 4,000. Doge is funny. Doge did all of that jumping when nobody else is doing anything, and now it's the only one in the red. That's just sad. It did that whole big spike off the tweet, and I guess they said it was a day early, so they don't need to come to the party today. They'll come a little bit later. Shiba not doing too much. Okay, they finally got it over 56 cents over here. Look at that, guys. Now if it was mirroring Bitcoin right now, Bitcoin is going down right now. It's a low dip. But over here, they got it getting ready to hit 57 cents. We can get up out of here if it hit 57 cents. Let's see if we can do that. Now we talking. But so let's see if they get it. Let's go to CoinMarketCap. CoinMarketCap. What they got things over here. Meta Pets. They just come out with freaking anything. Meta Face, Meta anything. And we can make some money, huh? All right. Okay, now CoinMarketCap is lower everywhere. Thanks for that like, my beautiful friend. Appreciate it. Okay, so I want to see, do they have Bitcoin just went down right here? I hate because it's hard to zoom in on this. Let me do it. I hate this freaking chart over here. It's a way I can do it. It's not letting me zoom all the way in. Let's see. It's at 1 minute. Okay. Where is the price? I can't go to my days I want. So yeah, I'll leave market cap alone because I want to zoom in. I like being able to zoom in and see exactly what's going on. So yeah, we'll go back to coin. We'll do Coinbase. Appreciate the likes. Where we at? Last hour. Okay, see, this is what I was talking about. You see in the last hour, we'd say at 340. We'd say at 340 it started going down. Now hopefully it's about to come back up. But 340 it started going down, right? Now let's look at Crow. And we're going to go to 340. At 340, if it was mirroring Bitcoin right now, it would have started going down. But what is it, 341? And now it's starting to go down a little bit, 347. So hopefully it push over. So we got it at 57 on Coinbase. So it's gonna be hard to get it to 58 unless it do a big jump, big spike. Man, I'm loving it. What's going on, everybody? How all is well? What did you miss with the Feds? The meeting actually went good. When he talked about cryptocurrency, it was funny because he said, well, cryptocurrency is not backed by anything, which is not a bad thing. It's like the US dollar. The US dollar is like the weakest currency out there. So he didn't speak bad about cryptocurrency. That's the main thing. So I think overall it did good for the market. He talked about, the basic stuff, the jobs. He had like a 15-minute opening intro where he just talked about what's going on in the market. And then they had a panel, like 20 different people was able to ask, hey, what do you think about the inflation on this? If you are inflating this, why is X, Y, and Z? So they did a full breakdown. Overall, I think it went great. Everybody, what y'all think? Do y'all think it went good? We survived. Daddy Powell. We survived it. Did good. Can't complain at all. The market started spiking soon as everything went up. So that was good to see. Let's read some articles. Let's see. Crypto PTO. Crypto news. Expand. Bitcoin spike to 49,000. Leave interest rates unchained. Fed speed up stimulus withdrawals. Let's see if I can pull up the Federal FED Reserve meeting. I know CNN, I'm all over it. Let's see. Watch Federal holds a briefing. All right, we will see. And for those, actually, I'll show you guys this. Now, on the Twitter, you can follow the Federal Reserve. Where I did say I'll show you. All right, so if you want to if some of y'all actually like the reading and like all the nerd stuff, you go to this one. You click this, and they actually show you the projections of what they plan on doing. This is like, hey, this is the real GDP. This is a September projections. They go unemployment rate. So it's just nothing but charts of what they are expecting. And I want it to go over 3%. This is target range for the federal fund rate. So yeah, if you like to do all of those, I know a bunch of YouTubers going to be doing videos on all those numbers. Me, that's too boring, and that's not going to help my retention rate. Let's see, what's trending on Twitter right now? How do you explore? It's weird looking at Twitter from like your what you call it, your computer. Let's see what we got trending. Travis Hunter, Bell Hooks. We know Powell somewhere in here. Federal Powell. There is a real risk that now inflation may be more persistent. The risk of higher inflation becoming entrenched has certainly increased. I don't think it's high at this moment, but I think it increased. Like, you don't think it's high. Let me show you guys. Okay. inflation rates right now. For those that don't think inflation is high, let's see what is all. If I can show you what all have inflated. I should have did like a full list. I know one of these articles probably got a list that show you from food, transportation, to anything you can think of. This the highest inflation has ever been in the last 39 years, I believe. I probably have to pre-look it up to show you guys exactly what I want to show. All right, let's see what else they're talking about. Powell don't see cryptocurrency as a financial stability concern. He said he said this as a quote. That was a great quote. Could be the bad actors in the government around the world have a problem with crypto because it is a financial stability solution. Hard to rob people that are empowered and financially independent. May good be with the people. He said that stable coins could be very, very good if regulated, and high risk crypto needs some regulation. Also, I didn't hear him say any of that. Unless he did it when he was out. Yeah, but it's great for the money supply of the Fed. Let's see what they got. Check this out. Bitcoin triple bottom pattern. So bottom. Let's see what they got. Trend reversal. There we go. Somebody did that yesterday. Done the same thing as me. Triple bottom pattern. Great thing about TA. Yeah. That is funny. On this day, 34 years. Yeah. Like Carl Winslow. Yeah, you gotta love good old Twitter. I actually just started going back on Twitter because I mainly just do like politics and sports to see what the heck is going on. Powell saved Christmas. VIX. It was an ETF that somebody actually told me to check out recently. I gotta see what it was. I forget. I did a live yesterday and he told me about it. We went over 500, y'all, on crypto.com. Shoot, y'all, this is probably gonna hit 50,000 at the rate this is going. Yeah, we might mess around and hit 50,000 people. We got a rally. Up on our hands. Ethereum just went over on 4,100. They just went back down, but yeah, we got a rally on our hands. Poly, come on, get to 57. No, okay. So it did go down right there on that dip. Yeah, we got a good rally going on. So I hope you guys enjoyed it. What I'm about to do is eat, go out, go make some money because I don't have nothing to do right now. So I'm going to eat, go out and make some money, probably go to the gym again because I have to do some stuff. And we're going to go live again tonight because I don't feel like recording a real video. I think I got 2 videos in mind I'm going to probably do. I just don't feel like recording them right now. So once I see what everybody is saying, we will bring it back later on tonight and keep the party going. I hope you guys enjoyed it. If you have any questions, always just put them in one of the comments. I always read them. I get to see them and we can talk about it when we come back live. And thank you guys for tuning in. Press that like button, press the subscribe button, give yourself a clap. Until next time, see y'all in a little bit. Later.